MP, Deputy Prime Minister and Treasurer, the Government of Australia. Minister.
Well, thanks very much, Christopher. I too have often asked why taxi drivers are the only people who know what's going on in a country. And I've certainly found them always very free with their advice, so you must have been particularly offensive to him. We have a particular mood in this country at the moment. It doesn't necessarily celebrate the strength of our financial system or indeed the strength of our economy, but I think it is well understood. We have the luxury of holding these opinions, unlike so many people in so many other countries who do not have the luxury of holding those opinions. Anyway, it's quite an appropriate time to be here to discuss the strength of our financial system. And in fact, after a period of relative calm in the first quarter of this year in financial markets, we can see the very dark storm clouds gathering again, particularly over Europe. And it's very clear that markets are anticipating the outcome of the Greek elections in just 3 days' time, and that is the source of great uncertainty in financial markets and more widely across the global economy. Now, while the trigger points are different at the moment, I think the underlying themes are the same. We have the same deep-seated challenges facing the common currency in the form of excessive sovereign debt, challenges in the European banking system, and of course the burning need for economic growth, particularly in Europe. And it is true to say that European policymakers have made some progress on structural reforms to boost growth and reduce debt, and they have begun the task of reinforcing their financial firewalls. But I think, as everybody in this room is aware, much more needs to be done. Certainly the recapitalisation of the Spanish banking system was a welcome initiative, but there are still many more questions that need to be answered there. A lot more work to be done, and we do need to see the final detail. So Europe does face not only those challenges, but I think a broader set of challenges, because the pattern that we've observed in Europe is now all too familiar. The fact is that the politicians in particular have been well behind the curve, and they have not taken advantage of the recent period of relative calm in financial markets to make further policy headway. There's no escaping the fact that there will be a long and painful road ahead in terms of adjustment in Europe, and we will see more bouts of volatility and crises to come. The fact is, and I do regret saying this, but I've said it personally and very clearly to my European colleagues through G20 meetings over the last couple of years in particular, they've just got a lot more heavy lifting to do. And what they do need to display is a lot more political courage than we've seen so far. The fact is they have a remarkable capacity, as you say in the colloquial terms, to be one campfire ahead of the posse. And they need to be doing a lot better than that. And there is a loss of patience with finance ministers outside of Europe with the pace of response of our European colleagues. And I think that is once again coming to a head as we go into a G20 meeting this weekend. But the fact is that leaders, whether they're in Europe or anywhere else in the world, are elected to lead, and that's what we do expect from our European colleagues. And there needs to be a lot more done to boost growth and to support job creation. There's no doubt they must accelerate the transition towards greater fiscal and financial union. They need to do that to strengthen the monetary union. And in the medium term, they must get their budgets back on a sustainable footing and persevere with the tough structural reforms that are so critical to building the competitiveness of the future. But here in Australia, we have had a proud history of fronting up to the tough structural reforms that deliver the resilience that is required in a modern economy. And it is those long and hard structural reforms put in place over a 30-year period that explain the underlying strength and resilience of the Australian economy. Not just what was done in the 80s and the 90s, the floating of the dollar, the bringing down of the tariff walls, the introduction of enterprise bargaining, the introduction of national competition policy, the introduction of national superannuation. All of those tough structural reforms have helped build the resilience of our economy. We've not seen a raft of those type of tough structural reforms across many parts of Europe, and they are suffering badly as a consequence of that. And all of those long-term, unpopular at the time, structural reforms have been the ones that have given the Australian economy the resilience that it required as we entered into the global financial crisis and the global recession. And also the fact that our financial system has been in good shape with some of the best regulators in the world. So this Australian model of structural reform, good supervision and fiscal responsibility is what does put Australia in a position of strength in this uncertain global environment. Now, like many of you in this room, I've spent a lot of time since the global financial crisis talking to investors, not just here, but across every time zone. And I think everybody here understands that investing in Australia is a pretty attractive proposition in the boardrooms of New York, London, Hong Kong and Tokyo. And the more we see the instability grip Europe, the more attractive that becomes, because our economic fundamentals are now the strongest in the developed world. We've got impressive growth, low unemployment, contained inflation, low debt, and a pipeline of mining investment worth over $500 billion. So much so that our economy grew a stunning 1.3% in the March quarter, outpacing every single major advanced economy over that period. Now, this translates to a growth rate of 4.3% through the year, making it the fastest growth in over 4 years. On top of that, we had job creation of something like 46,000 full-time jobs in the month of April, with the economy having created over 800,000 jobs since November 2007, at a time where we've seen millions and millions of people unemployed elsewhere in the developed world. What is particularly stunning is that our economy is now 10% larger than it was at the end of 2007. And as everybody in the room is aware, most developed economies have not yet got back to where they were at the end of 2007. And in the coming year, our economy will grow at trend, and it will be a $1.5 trillion economy. We are set to outperform every single major advanced economy, not just this year, but next year as well. Now, we're starting, as I said before, from a position of strength, in particular, not just because of the reforms that took place in the 80s and the 90s, but because we got the big economic calls right during the depths of the global financial crisis. We acted decisively in terms of fiscal stimulus to stimulate demand when global demand fell off a cliff. And of course, we didn't see the retreat of the private sector here as we did elsewhere. What that meant was that we were one of the few developed economies that avoided a recession, and that has given us such a firm foundation for future growth, because we are not living with the capital destruction and the skill destruction that comes with long levels of prolonged and high unemployment. In fact, in the March quarter alone, we grew faster than Germany, Italy, France or the UK over the whole year to March. And as I said before, with our economy forecast to grow at trend, we are now bringing our budget back to surplus to give the private sector further room to grow. Now, in these circumstances, it's appropriate that monetary policy again assume its conventional role as the primary tool for managing economic demand, while government keeps making long-term investments in the productive capacity of our economy. And we do require that with an investment pipeline of over $500 billion in resources alone. So balancing the budget ensures that the government is not generating price pressures in an economy where there is a huge investment pipeline. And of course, growing surpluses gives the Reserve Bank of Australia the maximum flexibility to cut interest rates if it thinks that's necessary. And we've already seen that confirmed by 125 basis points of official rate cuts since November last year. And with the global outlook still uncertain, and markets punishing those without a credible fiscal plan, it's critical that we continue with our budget discipline. Strengthening surpluses will underwrite confidence in our already very strong public finances as a foundation for confidence in our broader economy. And as I said before, Australia does have some of the strongest public finances in the developed world. We were recently upgraded to AAA by Fitch, meaning we now have the highest rating from all three global rating agencies for the very first time in Australia's history. And in fact, today we're only one of 8 sovereigns to be awarded the coveted AAA rating with a stable outlook by all three global agencies. And of course, every Australian business that raises capital in international markets has a very strong interest in our first-class sovereign rating. Because as you know very well, a sovereign balance sheet plays a very important role in supporting cost-effective issuance by financial institutions and other corporates. Our fiscal strategy builds on the decisive action we took during the depths of the global financial crisis to secure the flow of finance to the economy. Then we acted quickly to bring in the wholesale funding guarantee, which allowed our financial institutions to access offshore debt markets on competitive terms in return for an appropriate fee. And we also accelerated the introduction of the financial claims scheme we've been working on for some time to give Australian depositors confidence their money was safe in any bank, credit union or building society. And we also stepped up as a cornerstone investor to preserve the superstructure of the RMBS market through our AOFM investment program to support competition in the banking sector and the flow of credit to borrowers. All of this, together with the RBA's coordinated response and other government measures, all of this action helped keep unemployment low and has ensured that Australian mortgages remain amongst the highest quality collateral in the world. So there's absolutely no doubt that we face continuing global economic volatility from a position of strength. And just like the government's balance sheet is strong and getting stronger, we are determined to continue our agenda to strengthen the nation's balance sheet. And in particular, we have to do this because we are a capital-hungry nation. In recent years, our gross national saving has been around 24% of GDP, over 1/3 higher than the average of G7 countries. But our national investment is around 28% of GDP, around 50% higher than the average of G7 economies. So we have high national savings, but even higher national investment. Now, we've built up a very strong reputation as a stable and efficient importer of capital. Now, more than ever, we are an island of certainty in a sea of volatility, but we must continue our focus on building up our domestic funding capacity. We do need to do more to boost our national savings, while bringing the budget back to surplus is an important part of this. It's not the whole story. For those of you that are deeply interested in this topic, I urge you to read Statement 4 in Budget Paper Number 1, where I talked a bit about our national savings strategy and its importance to the future of our country. It sets out our strategy not just to boost national savings, public savings, but at the same time to also boost our private savings. And that's more important than ever with the global economic environment being so weak and fragile. The government's reform to boost superannuation from 9 to 12% will add $500 billion to Australia's national superannuation savings pool by 2035. This will see Australia's pool of superannuation savings grow from over $1.3 trillion to almost $7 trillion by 2037, by then around 130% of GDP. We're also putting in place measures to help build a deep and liquid corporate bond market, although clearly there's no silver bullet there. We brought the buy side together with the sell side last year for a roundtable to discuss the barriers to boosting domestic issuance in Australia. We're also making very good progress on streamlining disclosure and directors' liability for retail corporate bond issuance and the trading of CGS on a securities exchange in Australia. Now, it's just common sense that our financial institutions should have as many strings in their bow as possible when it comes to funding. And that's why in December 2010, I announced the Gillard government would allow covered bond issuance as part of our agenda to secure the long-term safety and sustainability of Australia's financial system. The announcement of this reform was a product of the government's very close work with industry and our regulators since at least early 2010. Following 2 rounds of consultation, I introduced legislation into Parliament to amend the Banking Act on the 15th of September last year. Now, I expect that date sort of rings true to many people in the room. It was, in fact, the 3rd anniversary of the collapse of Lehman Brothers, which I think we'd all agree was a focal point of the global financial crisis. There could not have been a more appropriate day to make the announcement on the issuance of covered bonds, a fundamental economic reform to diversify the funding options available to Australian financial institutions in our economy. In Parliament, I put the case for covered bonds based on a range of benefits that have since been demonstrated through the issuance of $30 billion of covered bonds. Access to this new, more resilient issuance class, so far issued in 5 different currencies apart from our own, has been absolutely crucial in helping our financial institutions weather heavy market turbulence. Against this backdrop of global instability, the capacity to issue for terms of up to 18 years is helping our banks continue to lengthen their maturity profiles and comply with new Basel III liquidity requirements. Domestic covered bond issuance is also helping to channel Australia's national superannuation savings through the financial system into productive investment in all sectors of our economy. Covered bonds have also provided access to cheaper funding relative to the cost of senior unsecured issuance, and spreads have tightened somewhat since their introduction. As I said last year, I thought it was absolutely critical to give our financial institutions access to this important market, given Canadian and Norwegian banks were coming here and cleaning up our savings. I was determined to give our financial institutions the tools they needed to compete for funds on a level playing field. And I'm also really pleased to see that one of our regional banks, Suncorp, has now executed a covered bond deal. I look forward to the day when the first group of credit unions and building societies get together to jointly issue under the framework that we've provided. But all along, we've been supporting smaller lenders through our highly successful RMBS program, along with the comprehensive package of other competition measures that we've already put in place. It's been very encouraging to see our regional banks and mutual lenders growing their market share over the last year or so, using many of our reforms, and I'd like to see them continue with more of the same. So in conclusion, I'd like to say I'm really proud of our competition reforms and our reforms to the financing of our banking system over the last couple of years. These have been actions which have not only been effective, but have strengthened once again the long-term resilience of our financial institutions. And we've done that in a timely way at a time where there has been great global instability. So the issuance of covered bonds and the legislation of covered bonds could not have come at a better time given existing global conditions. All of this is part of the government's broad agenda to get our economic conditions right for the challenges ahead while we make the most of our opportunities. I'd just like to say in conclusion how optimistic I am about the future of the Australian economy and how optimistic I am about the future of our regional economy here in the Asia Pacific. It's too easy to be distracted by events in Europe and their flow-on effects to the global economy. But the underlying shift in the global economy from west to east will continue, and it will continue irrespective of ups and downs in the current global economic cycle. The growth in the region is going to spring from immense productivity growth and investment across a whole range of countries in our region, not just China, but Indonesia, South Korea, Malaysia, Vietnam, and India, and so on. And with the Asian century will come not just a boom in demand for energy, as we see in our mining boom here now, but also in a boom for a whole range of much more sophisticated products and services, firstly in agriculture and then more broadly across other service sectors of the economy. So the future for Australia is not just in mining and energy, but it's in linking ourselves into what is termed here as the Asian century. And there is a fierce determination within our government to ensure that in the Asian century, it becomes an Australian century as well, where we are not just a passenger in the Asian century, but a central engine room in the growth of the region. As the 13th largest economy in the world, we have an essential role to play in becoming much more deeply embedded into regional economic and political and security frameworks, and from that, liberating a host of opportunities for the future of our economy that will see the growth that we've secured in recent years matched by a new wave of growth across service sectors and high-end manufacturing. For all of those reasons, plus the fact that we have a sound financial system which is well regulated and hopefully increasingly well funded, given the fact that we are lifting our savings ratio to accompany the fact that we have an investment boom which will continue for years to come, all of those reasons is to have fundamental faith in the ongoing strength not just of this economy but of the regional economy as well. I wish you well in your deliberations. Thank you.
Thank you very much indeed, Mr. Swan, for getting us off to such a cracking start.